Hi everybody, this is Ellman, the Blue Collar Investor, with today's covered call writing question of the day. And today's question comes from Robert, who has a very interesting question regarding contract adjustments. Hi Alan, I have a December covered call on Ingersoll Rand, ticker symbol IR, having sold the 7250 strike, and they just spun off part of the company called Allegion, ticker symbol ALLE. I now have 1/3 of a share of ALLE for every 1 share of IR. My question is, at what price am I at assignment risk? Well, Robert, what makes your question so interesting is that every contract adjustment is different. There's no one formula that I could give you that you can apply to every single contract adjustment situation. So when it occurs, what you have to do is you have to find out the particulars of the parameters of the new contract. And there's two ways of doing that. One is to go to a reliable site like cboe.com and look for contract adjustments. The other is simply call your broker up and ask your broker about it. Now, your broker probably will not have this information at his fingertips, but he certainly will have access to the information. So you simply ask him to do his due diligence and explain to you the parameters of the new contract. So in order to figure out when you're at assignment risk, let's first take a look at a screenshot that will review the trade that you made. So what you did here was you purchased 100 shares of IR someplace in the low 70s and sold the 7250 strike. Now, before expiration, IR spins off Allegion, and now IR is trading somewhere in the mid-50s. I don't know the precise numbers because it wasn't implicit in your question, but I'm making some pretty educated guesses as to the numbers here. And ALLE was trading somewhere in the low 40s. Now, for every share of IR that you own, you now also own 1/3 of a share of ALLE. So in order to figure out what the new parameters of the contract are, we have to go find either the site or call your broker. So what I did was I actually took a screenshot from the CBOE site that will explain the parameters of the new contract. And as you could see in the screenshot in front of you now, that this is taken directly from the CBOE site, you could see towards the bottom of the screenshot where it tells you that on December 2nd, for each IR contract, it will now deliver 100 shares of IR plus 33 shares of Allegion plus a little bit of cash. And again, that's the fractional amount after the 33 shares that 1/3 of a share will generate. So that gives you the parameters of the contract. Let's take a look now at the before and after of the actual option series of IR. And you could see on the left-hand side that the original series had listed IR as the underlying security. You could see that in the far left column. But if you look towards the middle of the screenshot, you could see that the new underlying security is now listed as IR1. So IR1 equals 1 share of IR plus 1/3 of a share of ALLE. The strike price remains the same. So what does all this mean? Well, when are you at contract risk? That was your question, and I figured you knew I'd get to that eventually. So here we have to do a little math. So let's take a look at the screenshot in front of you now, and that will determine precisely when you're going to be at assignment risk. We know from the information gleaned from the CBOE site that one contract will deliver 100 shares of IR at the new price plus 33 shares of ALLE at the current market value plus a little bit of cash, 0.3333 times the value of 1 share of ALLE. Now, assignment will occur when the value of 1 share of IR plus 1/3 the current market value of ALLE is greater than 72.50. Even by 1 penny, you will be at assignment risk. So let's go to an example here. Let's say on expiration Friday, IR is trading at 55 and ALLE is trading at 45. Well, the way we do the math is we say 55 plus 1/3 of 45, or 15, that totals 70. Well, 70 is not greater than the strike you sold, 72.50, so you will not be at assignment risk. However, if those stats do go over 72.50, again, even by 1 penny, you will be at assignment risk. So that's how you calculate it. Once again, Robert and everybody viewing this video, every contract adjustment is different. There is no one formula for it. So whether it's a merger, an acquisition, a spin-off, a takeover, a stock split, a one-time dividend, every contract situation is different. You have to either go to a reliable site like the CBOE site or speak to your broker and find out the precise parameters of the new contract. Now, as a general guideline for most retail investors like us, if you know a spin-off is coming, it's best not to get involved in a covered call writing position until after the spin-off occurs. However, if it occurs prior to expiration and you weren't aware of it, well, then again, do your due diligence, find out the parameters of the new contract, and then you could determine how you're going to manage your position. So, Robert, thanks so much for that question. Really appreciate it. Thanks to all of our viewers out there for watching this video. I hope you found it both useful and beneficial. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.